All right, we're going to do 17-4 now on page 1043. And once again, we have a difference between Macker's, 5 years Macker's property, which is appropriately listed, the rates there. And then straight line with no residual value for, and the machine costs $600,000. What we're going to do here is we have to calculate. We're going to have to calculate a number of different things. We've got parts A through C. Yeah, there's nothing on the next page for this problem. All right, so what they want is prepare all journal entries required to record Blue Collar's income tax provision for years 3 and 4. So if we see down there, the income before tax and depreciation for year 3 is $930,000. And so we'll go to book and tax. And so the tax depreciation is going to be $100,000. That's simply the $600,000 cost, no residual value, and a 6-year useful life. So the depreciation expense for book purposes is $100,000. And that gives us $830,000 in income before tax for book purposes. Okay, for tax purposes, our depreciation is going to be 19.2%. So 600,000 is going to be 1,115,200. And so if we subtract that, we get taxable income of 814,800. All right, so we're going to multiply both of these times our tax rate, which is given to us as 40%. That will be $325,920 for tax purposes. And $332,000 for book purposes. So our tax expense, our journal entry for year 3 will be tax expense $332,000, and taxes payable $325,900. We simply subtract those, and we get deferred tax liability of $6,100. Now, how did I know that was not reversing a deferred tax asset? And so I knew to be, and the reason is because I know that that a 6-year useful life, 1 divided by 6 is 0.17 or 17% roughly. 17%, 16.67. And so all 3 years, 1, 2, and 3, Macker's depreciation is going to be above the straight line depreciation. So I'm still building my deferred tax liability in year 3. Now, year 4, which is what we're going to do next, is going to reverse that deferred tax liability. So let's go ahead and take a look at that. In year 4, we have income of 1,100,000 before depreciation and tax. And so we do our depreciation again. That's 100,000 for book purposes, and that'll give us 1 million in income. But for tax purposes now, it's 11.52%. So 600,000. And that will be 69,120. And if we subtract the 110, oops, 1,100,000. We get 1,030,880. Okay, and so that will be our income. Now, if we multiply that times 40%, both of these times 40%, our taxes payable will be 412,352, and our tax expense will be 400,000. All right, so now I'm ready to do my journal entry. It'll be tax expense, 400,000, taxes payable, $412,352. Now, I need more credit in order to make this balance. It'll be the 12,352. And because I know I have a deferred tax liability that's been building the last 3 years, I will be reversing that. All right, so that takes care of part A, that problem. Then part B says, what is the balance in the deferred tax account at the end of year 3? Okay, so what I have to do now is I need to figure my depreciation expense for each of those years. I know what it is for tax. Or for book. It's 300,000, right? 3 years times 40% is 120,000. Okay, so that's how much tax savings I had on depreciation for book purposes. But I need to figure that for tax purposes. So the first year is 600,000 times 20%. And so that's 120,000. And then the second year is 600,000 times 32%. And that's 192,000. And then the third year I already calculated, that was the 19.2%. So that's the 115,200 that I calculated earlier. And so if I add those all up, I get 427,200. So if I subtract 120,000, I get 307,200. Right? And so that's my difference. I multiply that times 40%, which is my tax rate. And so the balance in my deferred tax liability at the end of year 3 is going to be this number, 122,880. Okay. Then the last part of this problem, part C, says what is the reported net income for years 3 and 4? All right. So let me put a new piece of paper here. So if you remember for year 3, on this part right here, we reported book income before the tax provision of $830,000. And this is year 3. And then we had a tax provision of $332,000. So 830 minus 332 gives us 498,000 for our reported income in year 3. Then if we go back, our year 4 income was $1 million before the tax provision. And then our tax was $400,000 to 40%. And that would be $600,000 is what we would report in year 4. Of course, we could do that also by just taking the 830 times 0.6 or the 1 million times 0.6. We'd end up with the same thing. All right. So that finishes exercise number 17-4.